1 year ago, $1 cost around 85 rupees. Today, it costs around 95 rupees. That is an 11% move in a single year. Most people saw the headlines and moved on. But this one number affects everything. Petrol prices, international travel, foreign studies, investment portfolios. So, what exactly happened? Why is the rupee falling? India has been one of the fastest growing major economies in the world for years. So here's a question. If India's economy is growing so fast, why is the rupee still falling? Shouldn't a stronger economy have a stronger currency? The answer lies in understanding what an exchange rate really measures. An exchange rate is just a price. Nothing more, nothing less. Just like the price of gold is determined by buyers and sellers, the price of the dollar is determined by demand and supply. When demand for dollars rises faster than supply, the dollar becomes more expensive. And when the dollar becomes more expensive, the rupee becomes weaker. So if India's economy isn't the problem, what is? The answer is simple. India needs a lot of dollars, and the supply of dollars doesn't always keep up. That imbalance is what moves the exchange rate, and there are four major forces behind it. The first is oil. India imports most of the crude oil it consumes, and crude oil is priced globally in US dollars. Every time Indian refiners buy oil from abroad, dollars have to be paid. That means a growing economy often needs more dollars, not fewer. More demand for dollars puts pressure on the rupee. The second force is foreign investors. When global investors put money into India, they bring dollars into the country. But when they decide to leave, the process works in reverse. They sell Indian assets, they receive rupees, and then they convert those rupees back into dollars before taking the money home. That increases demand for dollars, and it can weaken the rupee. The third force is exports. Every time India exports software, pharmaceuticals, engineering goods, textiles, or other products, dollars flow into the country. Those export dollars help offset the dollars we spend on imports. But if exports slow, while imports remain strong, the balance becomes harder to maintain. Fewer dollars come in, more dollars go out, and that puts additional pressure on the rupee. The fourth force is interest rates. Money moves around the world in search of returns. When the gap between US and Indian interest rates widens in favor of the US, dollar assets become more attractive. Global investors have a choice. And sometimes, the dollar capital that might have come to India stays in the United States instead. Less dollar inflow means less support for the rupee. And this is where GDP and exchange rates part ways. A country can grow rapidly, while still importing large amounts of oil, machinery, and electronics. In fact, growth itself can increase the demand for dollars. GDP measures what happens inside India. The exchange rate reflects India's financial relationship with the rest of the world. They are measuring two completely different things. A weakening currency is not automatically a sign of a weak economy. Sometimes, it is simply the result of trade flows, capital flows, and global money moving around the world. So the falling rupee does not necessarily mean India is in trouble. In fact, a growing economy can still have a weakening currency. But that doesn't mean it has no impact on your life. Because every time the rupee weakens, someone ends up paying the bill. And that's exactly what we'll explore next.